In jeder großen Finanzkrise passiert immer das Gleiche. Die meisten verlieren Geld und eine kleine Minderheit schützt ihr Vermögen fast unberührt. Nicht, weil sie Glück hatten, sondern weil sie Positionen hielten, die kaum jemand beachtet, vor allem nicht rechtzeitig. Silber spielte dabei eine entscheidende Rolle, aber nicht so, wie es die meisten Investoren verstehen. Denn es gibt genau 3 Silberpositionen, die jede moderne Krise überstanden haben: Inflation, Bankenkrisen, Währungsabwertungen und Marktpanik. Und die entscheidende Frage ist nicht, ob sie wieder gebraucht werden, sondern wer diesmal vorbereitet ist und wer nicht.
September 15, 2008, Lehman Brothers collapses. Silver, which had been trading near $19 earlier that year, plunges to roughly $9 by October, a roughly 53% drop in months. Fast forward to March 2020, the pandemic shock sends spot silver down from about $18 to roughly $11.75 in a few brutal weeks, a decline near 40%. Then 2022, the Federal Reserve launches the fastest rate hike cycle in decades, and silver cuts nearly 30%, sliding from about $26 to near $18. 3 crises, 3 very different triggers, 1 repeating pattern. Some ways of holding silver not only survived each crash, they captured the rebound and, in some cases, produced outsized gains. In this video, I'm going to show you the 3 silver positions that existed across these crises: physical metal, mining equities, and paper positions like ETFs and futures, and trace how each behaved in 2008, 2020, and 2022. I'll explain the mechanics behind why one of these positions repeatedly outperformed, then lay out scenarios for the next crisis given the current supply picture. This is historical analysis and scenario planning. It is not financial advice. Start with the taxonomy. Physical silver means allocated coins and bars you own outright. American silver eagles, Canadian maple leaves, bullion bars held allocated to you. Mining positions are equities and funds that own miner shares, including industry ETFs. Paper positions cover ETFs like SLV, futures contracts, and synthetic products that promise exposure to silver without immediate physical delivery. Those are the 3 columns we'll keep returning to. Why care? Because when markets panic, the mechanics that normally make one form of exposure convenient suddenly flip into liabilities. Paper products rely on custodial logistics and the ability to create shares. Miners depend on capital markets and credit availability. Physical metal has limited immediate liquidity but unique optionality when supply tightens. You'll see that pattern play out in each crisis. Let's walk through 2008, 2020, and 2022 one by one, and then stitch the lessons together. In 2008, the trigger was a credit freeze. Banks stopped lending to each other. Counterparties stopped trusting counterparties. Risk assets imploded.
Silver's price trajectory that year is stark. After peaking near $19 in February 2008, it fell to roughly $9 by October. That's the backdrop. What happened to physical metal? Physical holders felt the price pain. Spot fell. But something else happened at the retail level. Premiums spiked. Coins and small bars, normally sold at modest premiums over spot, for example, American silver eagles, historically traded a couple dollars over spot in normal markets, began to trade at far higher marks. Dealers reported anecdotal premiums that, by some accounts, ran into the tens of percent. Market anecdotes put some coins trading at premiums approaching roughly 80% in pockets of the market. Why does that matter? Because physical metal is optionality. If dealers can't source new product fast enough, a holder who refuses to sell can later access those premium markets on the way up. From the October 2008 low to the April 2011 high, spot silver climbed to about $48.70, a rise of approximately 435% from that low. Physical owners who held through the squeeze or who sold selectively into premium-rich markets captured enormous value, compared with those who were forced to liquidate at low spots. Mining stocks told a different story. Because miners depend on capital and credit to keep operations running and to fund capital-intensive projects, they are levered to both metal prices and the health of financing markets. In 2008, many miners were squeezed by the credit freeze. Balance sheets deteriorated, projects were delayed, and some companies issued equity at distressed prices. That dilution and operational stress meant many mining equities did not participate proportionally in the subsequent precious metal rally. Operational costs, higher borrowing costs, and in some cases bankruptcies or distressed restructurings translated into permanent losses for many shareholders. The equity recovery lagged the metals rebound, and small-cap miners were hit the hardest. Paper positions, represented by ETFs and futures, acted in yet another way. ETFs tracked spot moves closely during the crash, but they could not capture the retail premium on physical coins and bars. An ETF holder is long the paper claim on metal. They do not own optionality to demand and remove physical metal without going through creation-redemption mechanics, and those mechanics can break down when physical supply tightens. In 2008, the primary lesson was this: paper tracks spot very efficiently under normal conditions, but it does not give holders the same access to the premium markets that appear during supply squeezes. So 2008 ends with a clear triage. Physical owners could benefit from elevated premiums and the subsequent rally. Miners were vulnerable to credit and dilution. Paper holders were convenient but often unable to capture the pie that opened up for physical sellers during the recovery. Now let's move to March 2020. March 2020 was a liquidity panic triggered by a global pandemic.
Mines shuttered, refineries slowed, and mint capacity was constrained just as demand from retail buyers surged. In the early weeks of the COVID shock, spot silver plunged from around $18 in early March to about $11.75 mid-month, near a 40% drop amid an overall market flight to cash. Physical metal? It became scarce. Dealers and mints reported extraordinary demand and interruptions to supply chains. Anecdotes from the market show examples like coins trading for more than 180% spot in extreme pockets. More commonly, documented dealer quotes indicated American silver eagle premiums ballooned. In some snapshots, dealers were asking $23 for a coin, while spot traded near $12. That's a premium north of 90% on a per-coin basis. What explains that? Two things: production disruptions, mint and refinery shutdowns, and a surge of retail demand. Physical holders who already had metal either found opportunities to sell into a panic-driven premium or simply rode the recovery. From the March 2020 low to August 2020, spot silver rose roughly to $29, about a 146% gain from the low. Physical optionality again mattered. Owning metal you can take delivery of allowed access to those premium pockets that the paper market couldn't replicate. Miners in 2020 were hammered on two fronts. First, operational stoppages and lower output hit near-term cash flows. Second, equities were sold alongside broader risk assets, magnifying downside beyond the move in the metal. Some miner equity baskets plunged as much as 60% or more in that period, versus roughly a 40% spot decline, meaning miners underperformed spot by a wide margin. When miners needed capital to restart projects or shore up balance sheets, they often issued equity at distressed prices, diluting existing shareholders. That structural vulnerability, operational leverage plus capital market dependence, makes miners a less reliable proxy for metal ownership in crisis windows. The paper side offers a particularly instructive episode in March 2020. SLV, the largest silver ETF, temporarily suspended or constrained its share creation mechanisms in that crisis window because sourcing allocated metal at scale became difficult. The mechanics are important. ETFs operate by creating and redeeming shares through authorized participants who deliver or receive metal. In a supply squeeze, authorized participants can't find physical metal to deliver, or the fees and frictions to do so become prohibitive. When share creation is constrained, an ETF can trade at a discount or premium to NAV, and holders lose immediate access to physical metal unless they go through cumbersome redemption processes, if those redemptions remain available at all. In short, convenience can become a liability when the underlying commodity becomes scarce. By now, a pattern is emerging. Physical captures premium optionality, miners suffer operational and capital stresses, and paper is exposed to creation-redemption fragility.
That brings us to 2022. 2022's shock was different: policy tightening. Rapid interest rate increases and a rotation out of non-yielding assets pressured precious metals. Silver fell from around $26 to near $18, roughly a 30% drawdown. The macro was one of tightening liquidity, but not a collapse of capital markets like 2008 or the sudden production stoppage seen in 2020. Physical demand in 2022 and the post-2022 period was notable for a different reason. Investors increasingly sought allocated metal as a hedge and as a store of real assets amid inflation and uncertainty. The Silver Institute and industry tallies recorded record or near-record physical investment in certain periods, and dealer reports show steady retail buying even through the drawdown. Premiums during 2022 did not necessarily spike to 2020 extremes across the board, but the depth of the physical market had changed. Inventory levels, mint backlogs, and global flows had tightened relative to earlier decades. As prices recovered, physical ownership again allowed holders to bypass paper frictions and to access realized gains from the metal's rebound. By some later reference points, the recovery trajectory continued toward materially higher levels. For instance, using the transcript's horizon, moving to a hypothetical later peak near $64.66 would represent roughly a 259% gain from the 2022 low. Remember to treat that as a directional recovery number tied to the transcript's framework rather than a guaranteed outcome. Miners in 2022 were squeezed by rising input costs and higher borrowing costs. Inflation pushed up diesel, power, and labor costs, compressing margins even as metal prices were under pressure. That combination erodes miners' free cash flow and makes capital-intensive projects harder to execute. The result? Mining equities once again lagged the metal's recovery in many cases, as investors penalized companies with weak balance sheets or those forced into dilutive capital raises. ETFs and futures tracked spot closely through the 2022 drawdown, but did not provide holders with the optionality to claim physical metal quickly.
Fees, custodial arrangements, and the need to coordinate with authorized participants left paper holders exposed to liquidity and logistical friction, even if there was no formal suspension like in the March 2020 episode. The convenience of paper again showed its limitations in moments when physical channels tighten or when premiums open up for coins and bars. Now step back and synthesize. Across these three modern crises, the recurring pattern is clear. Physical metal offers optionality. When supply tightens and premiums spike, allocated physical holders can sell into those premiums or simply retain a scarce asset until prices normalize or surge. Whether you realize those returns depends on individual behavior. Discipline matters.
But mechanically, physical ownership is the only one of the three positions that can capture the premium that appears when retail demand and unstrained supply meet. Miners are operationally and financially levered. They are businesses with capex needs, debt covenants, labor requirements, and exposure to input cost inflation. In a crisis driven by credit shortages or rising costs, miners often underperform the physical commodity because the company's capital structure and execution risk can permanently erode shareholder value. Paper positions provide liquidity and low-cost exposure in normal markets, but are vulnerable to custodial and share creation mechanics. ETFs track spot exposure well most of the time. They're efficient, cheap to trade, and simple to hold. But in supply squeezes, the logistics of sourcing metal for creation or fulfilling redemptions can stall. Suspensions of share creation and NAV ETF disconnects are documented structural weaknesses, not hypothetical. Fees and the inability to convert cheaply into physical metal are real opportunity costs when premiums are high. Put another way, physical is optionality, miners are operating leverage, paper is counterparty and logistical exposure. Those three archetypes map across crises as the main drivers of divergent outcomes. Let's quantify the comparative performance across each crisis in more concrete terms so the pattern sticks. In 2008, spot fell from roughly $19 in February to about $9 in October, about a 53% drop. From that October 2008 low to the April 2011 high at approximately $48.70, spot gained about 435%. Physical holders either sold into premiums during the rebound or rode that move directly. Mining equities facing credit-constrained capital markets, many failed to participate equivalently due to dilution and operational setbacks. Paper tracked the spot drop in recovery, but did not capture the premium differential that coin and bar sellers could access. In March 2020, spot fell from around $18 to $11.75, a near 40% drawdown. From that low to the August 2020 peak near $29, the metal returned roughly 146%. Anecdotal dealer reports show coin premiums ballooning in that window, with certain coins priced at about $23 against spot around $12 in the most intense moments, indicating premium spikes in the neighborhood of 90% or more on those instruments. Miners often declined by roughly 60% or more, notably worse than the spot move, due to operational stops and capital market pressure. SLV and others experienced functional limits, creation mechanics were strained, and in some cases, temporarily curtailed. In 2022, spot's roughly 30% decline from $26 to $18 was followed by a more complex recovery. Industry-ratified measures of physical investment showed substantial flows into bullion and coins, suggesting sustained demand at retail and institutional levels. In the transcripts framing, a later recovery to a level near $64.
66 from the 2022 low would equal about a 259% rise. Treat that as part of the pattern illustration rather than a forecast. Why did physical so consistently emerge as the protector or the best performer through the rebound? The answer is in the supply chain and the nature of scarcity. Physical metal has a real-world production rate. Mines extract ounces, refiners process them, and mints convert blanks into coins. That physical pipeline cannot be instantly scaled to meet sudden surges in retail purchasing. When demand spikes or when export flows tighten, as we saw with mint backlogs in 2020 and restricted flows in certain global corridors, dealers and authorized participants face a simple constraint. There is not enough minted, allocated metal to hand over immediately without paying higher prices or waiting. That reality creates premiums that only allocated physical holders can exploit. Paper products rest on an assumption of fungibility between the paper claim and deliverable metal. Under normal conditions, that assumption holds. But when the link is stressed because inventories fall, because logistics slow, because a major custodian's inventory has been drawn down, the assumption breaks temporarily. Authorized participants may find it uneconomical or impossible to source metal for creation. When that happens, ETFs can disconnect from the physical market, futures can show backwardation, and holders of paper lose the right to immediate delivery unless they manage redemptions that may become complex or illiquid. Miners, finally, are saddled by another kind of constraint, time and capital.
Building or reopening a mine, restarting a stalled processing plant, or ramping up throughput takes months to years and capital that may be unavailable or extremely expensive during a crisis. Operational leverage works both ways. When metal prices spike, successful miners can benefit. When prices crash or input costs spike, miners can suffer catastrophic damage to balance sheets. All that said, a critical caveat: owning physical metal is not frictionless. Storage, insurance, and reporting costs exist. Liquidity for large bars is different from liquidity for 1-ounce coins. There can be bid-ask spreads and dealer markups. And behaviorally, many retail holders sell out of panic rather than waiting for premium opportunities. The mechanical advantage of physical optionality only turns into superior outcomes if the holder understands the market dynamics and acts with discipline. Again, this is historical analysis and scenario planning, not financial advice. Which brings us to today's setup and why the stakes for the next crisis could be materially higher. Several supply-side indicators deserve attention. COMEX registered inventories, which represent the portion of exchange-eligible metal that sits in easily deliverable form, have declined meaningfully over recent years relative to historical baselines.
Meanwhile, policy and trade measures from major producers and processors, for example, tighter export controls or slowing refinery throughput in some regions, have the potential to limit cross-border flows. Industrial demand for silver, from photovoltaics to electronics, has continued to grow relative to primary mine supply, and mine production is not on an expansionary trajectory sufficient to absorb both rising industrial use and increased investment demand. Many analysts project a structural deficit in silver, mine supply plus recycled supply falling short of total demand, extending toward 2030 in various scenarios. Those are not certainties, but they are documented projections and working hypotheses that change the optionality landscape. What does that mean for a future crisis? Let's lay out 3 graded scenarios as thought experiments, label each as a projection or scenario, and examine plausible outcomes for physical, miners, and paper positions. Scenario A, mild panic, projection. A short-lived market dislocation causes a swift flight to liquidity. Spot drops by 20–35% briefly, then recovers as central banks and liquidity measures stabilize markets. Physical premiums widen modestly in the panic but normalize within weeks. ETFs and futures face transient frictions but no major structural breakdowns. Miners underperform in the short term due to equity risk-off but recover as financing resumes. Under this scenario, physical still offers a small edge in premium capture. Paper holds liquidity advantages. Miners are volatile but ultimately recover. Scenario B, severe supply-constrained panic, projection. A macro shock comparable to a banking system scare or a sudden export restriction blip causes both a demand surge for physical and real disruption to mint refinery throughput. Spot falls initially but then snaps back as premium pathways open. Physical premiums spike. Model scenarios here suggest that premiums could rise multiple-fold from normal levels. As a thought experiment, those spikes could reach 100 to 200% in acute pockets where coin scarcity is severe and dealers have constrained inventories. ETFs and futures experience acute stress. Share creation becomes difficult. Some authorized participants delay or limit creation, and NAV price dislocations persist for an extended period. Miners suffer from disrupted capital markets and supply chain inflation. Many underperform the commodity on the rebound due to lasting capital structure damage. Scenario C, extreme systemic event. In this modeled extreme, simultaneous financial system strain and physical flow restrictions mean that paper markets no longer reliably map to deliverable metal. Backwardation in futures is extreme. COMEX deliverable inventories are effectively exhausted for immediate need, and physical premiums for retail coin sizes spike to multiples of spot price in certain windows.
Under this scenario, physical metal is arguably the only asset form that guarantees optionality to the holder. Paper positions might trade in a parallel universe disconnected from deliverable reality, and miners could be permanently impaired by financing and operational failures. These are tail scenarios. Their probability is uncertain, but given inventory trends and tightening flows, they cannot be dismissed outright. Notice the common thread. As supply tightens and premium dynamics intensify, physical ownership's optionality becomes more valuable. Paper's convenience becomes a structural weakness when the logistics linking paper to metal are strained. Practical implications follow logically, and they are framed as questions you should ask, not instructions, not allocations. First, what exactly is your exposure? Is it allocated physical metal, or is it a paper proxy? Second, if you hold paper, do you understand the ETF's custodial model, authorized participant ecosystem, and the ETF's access to allocated metal during stress? Third, if you hold miners, have you examined balance sheet strength, net debt, and the company's ability to weather a prolonged cash flow interruption?
Fourth, if you hold physical, have you accounted for storage, insurance, and the potential cost to liquidate in a stressed market? These are analytical checkpoints, considerations for scenario planning rather than directives. Two more operational notes that often get overlooked. 1. Premium capture on physical requires a different skill set than trading paper. Selling into premiums during a spike often means having relationships with multiple dealers or accepting higher transaction costs to get immediate liquidity. 2. Timing and mindset matter. A panic that wipes paper values temporarily may not result in the same behavior from physical holders, who might be more inclined to hold through volatility or to sell selectively into an expanding premium. Before we close, a short reality check on numbers and attribution. The historical percent moves I referenced, the 53% decline in 2008, the 40% drop in March 2020, the roughly 30% drawdown in 2022, are anchored to observed spot price ranges in those windows. Similarly, the recovery magnitudes referenced, about 435% from the October 2008 low to the April 2011 high, about 146% from the March 2020 low to the August 2020 high, and a 259% figure connected to the transcript's later recovery illustration, are drawn from the same historical ranges and the transcript's framework. Premium anecdotes, for example, American Silver Eagles trading at multiples of their typical $2 over spot markup, are market anecdotes and dealer reports that illustrate how retail premiums widen during supply stress. They are not guaranteed repeatable outcomes but documented behaviors under strain.
And remember, when I say SLV or other ETFs experienced constraints on share creation during March 2020, that refers to documented operational,
where authorized participants found it difficult to source allocated metal quickly, and operational vulnerability, not a presumption of malintent. So what should you do with this understanding? Not a prescriptive answer, but a strategic one. Map your exposure and test it against the 3 crisis templates we walked through. If you rely on paper to mimic physical, recognize the conditions under which that mapping could break. If miners are part of your allocations, check balance sheet resilience and understand that operational problems can permanently impair equity value, even if the metal recovers. If you hold physical, decide whether you hold small, retail-sized coins for flexibility and premium capture, or larger bars where liquidity behaves differently, and factor in storage and insurance. One final point about the broader supply picture. If projected structural deficits toward 2030 materialize, lower relative mine growth, increasing industrial demand, and plateauing recycling, then the next crisis could produce larger premium dislocations than in past episodes. That's a projection, not a certainty. But even treating it as a low-probability, high-impact scenario changes the calculus for risk management. Optionality becomes more valuable the tighter the physical market is expected to be. This is not financial advice. This is historical analysis and scenario planning. If this headline grabs you and you want a deeper operational map of how the physical supply chain is controlled, who mints, who refines, who arbitrages between paper and metal, watch the follow-up video where we trace supply control, custodial distribution, and the actors who matter most when the market stresses. Understanding the mechanics will complete the picture. To summarize, across modern crises, 3 silver positions behave consistently differently. Physical silver offers optionality that can capture premium-driven gains when supply tightens. Mining equities carry operational and capital risk that can permanently reduce shareholder value in crises. Paper positions are convenient and efficient in normal markets, but expose holders to custodial and creation redemption frictions that appear exactly when those capabilities are most needed. If supply-side tightening and inventory depletion trends continue, the divergence between these 3 positions in the next panic could be wider than what we saw in 2008, 2020, or 2022. For now, map your exposure, ask how deliverable your holdings are, and consider which scenario you're implicitly positioning for. And if you want the full decomposition of who controls the supply, the mints, the big custodians, and the arbitrage channels that connect paper to metal, click to the next video.